Imagine being the world's second largest economy and feeling like your voice isn't being heard. That's the reality for China within the International Monetary Fund, IMF. As the global economic landscape shifts, China finds itself at odds with an institution it believes doesn't represent its interests or the needs of developing nations. In today's video, we'll dive deep into why China is turning away from the IMF and exploring alternatives that could reshape global finance. China's relationship with the IMF has become increasingly contentious, especially in its rivalry with the United States. Beijing has raised several complaints about its treatment within the IMF, emphasizing a lack of fairness and adequate representation in decision-making processes. Despite its significant economic contributions, China feels marginalized, leading to calls for reform of the IMF's quota system to better reflect current global economic realities. China criticizes the stringent conditions and perceived political bias of IMF loans, arguing these often do not address the unique needs of developing countries, hindering their growth. Additionally, Beijing is frustrated with the slow pace of IMF reforms, attributing this to resistance from the US, which maintains substantial control through its significant voting share and veto power. In this video, we will explore the confrontations between China and the IMF, and why China is considering alternatives to the IMF and other traditional financial systems. The IMF, established in 1944, aims to ensure global financial stability, promote high employment, and reduce poverty. It provides financial assistance and advice to countries facing economic difficulties. The IMF's power dynamics are heavily influenced by its largest shareholders, particularly the United States, which wields significant voting power. Despite being the world's second largest economy, China's influence within the IMF doesn't match its economic stature. Beijing argues that the current quota system, which determines a country's financial contribution and voting power, is outdated and unfairly favors developed Western nations. But it's not just about representation. China's frustrations with the IMF run deeper. Let's dive into the key issues fueling this discontent. Underrepresentation in the IMF. Firstly, China feels that its economic contributions are not adequately reflected in its voting power, leading to calls for reforming the IMF's quota system to better represent today's global economic realities. The current quota system is based on a formula that considers a country's GDP, economic openness, economic variability, and international reserves. This formula tends to favor advanced economies, particularly those in the West. China's GDP is second only to that of the United States, and its economic influence is felt globally through trade, investment, and financial markets. Yet, its voting share in the IMF does not reflect this reality. As of now, China's quota stands at 6.41%, significantly lower than the United States' 17.46%. This disparity means that China's voice in the IMF's decision-making processes is not proportional to its economic size and influence. Beijing has been advocating for a reform of the quota system to ensure that it reflects the current global economic landscape. This would mean increasing the quotas of emerging economies like China and reducing the disproportionate influence of advanced economies. However, these proposed reforms have met resistance, particularly from the United States, which has a vested interest in maintaining its dominant position within the IMF. Stringent loan conditions. Secondly, Beijing criticizes the stringent conditions attached to IMF loans. These conditions often require borrowing countries to implement austerity measures, which can be politically and socially destabilizing. China argues that these measures don't consider the unique needs of developing countries and can hinder their growth rather than support it. The IMF's conditionality often includes requirements such as fiscal austerity, monetary tightening, and structural reforms aimed at reducing budget deficits and controlling inflation. While these measures are intended to restore economic stability, they can also lead to severe social and economic disruptions. Austerity measures can result in cuts to public spending on essential services like healthcare, education, and social welfare, disproportionately affecting the most vulnerable populations. China has expressed concerns that the IMF's one-size-fits-all approach to economic stabilization does not account for the specific circumstances and development needs of borrowing countries. Beijing advocates for a more flexible approach that considers the individual economic contexts and development goals of each country. This perspective is rooted in China's own experience of rapid economic growth, which has been achieved through a combination of state-led investment and gradual market reforms, rather than the wholesale implementation of austerity measures. Slow pace of IMF reforms. Thirdly, China's frustration is compounded by the slow pace of IMF reforms. Beijing attributes this sluggishness to resistance from the US, which maintains substantial control through its significant voting share and veto power. This resistance to change has only intensified China's calls for a more equitable and representative international financial system. The IMF has recognized the need for reform and has made some progress in increasing the representation of emerging markets and developing countries. The 2010 IMF Quota and governance reforms, which came into effect in 2016, resulted in a shift of more than 6% of quota shares to emerging markets and developing countries. However, these changes have been incremental and have not significantly altered the overall balance of power within the institution. China has been particularly vocal about the need for more substantial and faster reforms. Beijing argues that the IMF must adapt to the changing global economic landscape, where emerging markets and developing countries play an increasingly important role. This includes not only adjusting the quota system, but also reforming the governance structure to ensure a more equitable distribution of power. China's alternatives to the IMF. Faced with these challenges, China isn't just waiting for things to change. It's actively exploring alternatives to the IMF. One notable initiative is the Asian Infrastructure Investment Bank, or AIIB, which China established in 2015. The AIIB supports infrastructure development in the Asia-Pacific region and beyond, providing an alternative source of funding without the stringent conditions typical of IMF loans. The AIIB has quickly gained traction, with over 100 member countries and billions of dollars in approved projects. Its focus on infrastructure development aligns with the needs of many developing countries, which require substantial investment in transportation, energy and communication networks to support their economic growth. Unlike the IMF, the AIIB does not impose austerity measures as a condition for its loans, making it a more attractive option for many countries. Another significant move is China's involvement in the BRICS New Development Bank, which includes Brazil, Russia, India, China, and South Africa. This bank focuses on funding development projects in member countries and other emerging economies, again providing an alternative to traditional Western-dominated financial institutions. The BRICS New Development Bank aims to mobilize resources for infrastructure and sustainable development projects in BRICS and other emerging economies. It also seeks to promote financial cooperation among BRICS countries and support their efforts to achieve sustainable development goals. The bank's governance structure ensures equal voting power for each member country, addressing one of China's key concerns about the IMF. By creating and supporting these alternatives, China aims to reduce its reliance on the IMF and promote a more multipolar financial world order. Implications for the global economy. So what does China's rejection of the IMF mean for the global economy? Firstly, it underscores the shifting power dynamics in international finance. As China and other emerging economies gain more influence, there's increasing pressure on traditional institutions like the IMF to reform and adapt. China's push for IMF reform is part of a broader trend where emerging markets are demanding a greater voice in global governance. This shift could lead to a more balanced and equitable international financial system. However, there's also the risk of fragmentation. If countries start relying more on regional alternatives and less on global institutions like the IMF, we could see a more divided and less coordinated approach to global economic challenges. China's stance could influence other countries dissatisfied with the IMF. By offering alternatives like the AIIB and the BRICS Bank, China provides a blueprint for other nations seeking financial assistance without the strings attached by traditional Western institutions. This could lead to a significant realignment of global financial flows, with more countries looking east rather than west for their development needs. China's rejection of the IMF is more than just a bilateral issue. It's a reflection of broader dissatisfaction with the current global financial order and a call for a more balanced and inclusive system. As Beijing continues to push for reform and build alternatives, the landscape of international finance is likely to change significantly in the coming years. In summary, China's growing discontent with the IMF is driven by issues of representation, the conditions attached to loans, and the slow pace of reform. By exploring and creating alternatives, China is not only seeking to address its own concerns, but is also influencing the global financial landscape, pushing for a system that is more reflective of the current economic realities. This shift highlights the evolving nature of international finance and the increasing need for global institutions to adapt to the changing dynamics of the world economy. China's initiatives like the AIIB and BRICS Bank are steps towards a more multipolar financial world order, challenging the traditional dominance of Western institutions. This realignment of global financial flows underscores the importance of equitable representation and tailored financial solutions in fostering sustainable economic growth. As we continue to monitor these developments, it will be crucial to consider the broader implications for global economic stability and cooperation. For more videos on the most important topics from the world of economics, please subscribe to Tree's Economy. Thanks for watching.